Hello, everyone, and welcome back. If you've been tracking the stock market even a little bit lately, you've probably noticed a common trend. There are certain companies that quietly put in the work behind the scenes, but the moment volatility hits, the entire market shifts its attention toward them. Today, we are diving deep into one such stock that has experienced a whirlwind of conflicting news over the last 24 to 48 hours. It's news that has left retail investors both deeply concerned and incredibly excited. Yes, I am talking about Redwire Corporation, ticker symbol RDW. Right now, if you pull up the RDW chart or gauge the market sentiment, you will see two completely different narratives playing out simultaneously. On one side, we have monumental fundamental catalysts that could fundamentally scale this company's business to the next level, including an international contract that alters their revenue potential. But on the flip side, short sellers have suddenly stepped into the arena, trying their best to inject fear, uncertainty, and doubt, better known as FUD, into the minds of retail investors. Whether you already hold RDW shares in your portfolio, or you are looking at these current dips as a potential entry point, pull up a chair and wait. Over the next few minutes, we are going to lay out all the facts. We will break down the two major catalysts that just hit the wires and dissect the short report that has been suppressing the stock price. Make sure to listen until the very end, because today's analysis might just change the way you look at market psychology. Let's start with the biggest piece of positive news making headlines this week. Redwire Corporation is traditionally recognized as a space exploration and satellite infrastructure pure play. However, they just pulled off a strategic move that proves their long-term vision extends far beyond the upper atmosphere. They have officially secured a critical, high-profile contract with the Taiwan Coast Guard. Now, you might wonder, why does the Taiwan Coast Guard need infrastructure from Redwire? Well, this contract centers around their acclaimed Penguin Mark 2.5 VTOL uncrewed aerial system. These are not your everyday, consumer-grade drones that you see in local hobby shops. These are high-tech, military-grade, vertical takeoff and landing uncrewed systems. What makes this significant is that they require no runway to operate. They can launch vertically right from the deck of a vessel in the middle of rough seas. Think about the global geopolitical landscape for a moment, and consider just how sensitive the geographical and political climate of Taiwan is right now. In such an environment, for the Taiwanese government and its Coast Guard to place their trust in Redwire's technology for maritime surveillance and security is a massive validation. This contract proves that Redwire's unmanned aerial vehicle, or UAV segment, is gaining global defense adoption. It diversifies their revenue streams and significantly elevates their brand credibility on the international stage. Next, let's talk about the second major update, which ties directly into the company's financial war chest. In the stock market, there is an old saying that remains undefeated. Cash is king. You could have billions of dollars in potential orders, but if you lack the immediate liquid cash to execute them, your business can stall out. Redwire just made a very calculated financial move to eliminate this exact operational risk. They have expanded their revolving credit facility, raising it straight from $30 million to $50 million. But they didn't stop there. Alongside increasing their borrowing capacity, Redwire simultaneously cleared a substantial $40 million payment against their older term loans. Let's analyze the underlying mechanics of this transaction. When a growth company aggressively pays down its older debt while securing a higher credit line, it signals immense strength to banks and financial institutions. It means Redwire now possesses substantial liquidity to fund its incoming high-tech projects, satellite launches, and defense manufacturing requirements. For growth-stage companies, the primary fear among investors is usually the threat of insolvency or running completely out of runway. However, Redwire's management has just demonstrated serious fiscal discipline. They aren't just accumulating debt, they are actively managing and paying it off. This balance is a classic hallmark of a fundamentally healthy, scaling business. This brings us to the core issue that likely brought you to this video today. If all these incredible milestones are being met, securing international defense contracts and gaining stronger banking backlines, then why has RDW stock faced downward pressure over the last few sessions? Why are we seeing red candles print across the daily chart? The answer lies in a psychological warfare game currently playing out in the market. A short-selling research firm, Fugazi Research, recently published a highly aggressive bearish report targeting Redwire. Their main thesis revolves around the company's free cash flow remaining in negative territory, and they argue that the recently announced $500 million at-the-market, or ATM, equity program will heavily dilute existing shareholders by flooding the market with new shares. Let's take a step back and objectively analyze this claim. Is dilution a valid risk? Yes, absolutely. Whenever a company reserves the right to issue new shares to raise capital, it naturally creates short-term downward pressure on the stock price. But you must understand the underlying business model of short sellers. Their primary objective is to trigger panic, shake out retail investors, and manufacture synthetic fear. Once retail investors panic sell their positions at a loss, the short sellers cover their positions, lock in their profits, and move on. The ground reality, however, tells a vastly different story. Redwire's contracted backlog currently stands at a massive $411 million. Furthermore, management's fiscal guidance for this year projects revenues coming in between $450 million and $500 million. That translates to an astronomical year-over-year revenue growth rate of nearly 49%. So you have to ask yourself a logical question. Do you trust a company that is growing its top-line sales by 50% annually with hundreds of millions in guaranteed contracts, or do you let a short report dictate your financial decisions? Whenever you find yourself caught in market confusion, it is always wise to filter out the noise and look at what the institutional heavyweights and Wall Street analysts are doing. Right now, out of the major analysts who track Redwire around the clock, 4 maintain a strict buy rating, while the remaining 2 have it rated as a hold. More importantly, their consensus 12-month average price target sits at a robust $17.60. Considering the stock is currently consolidating around the $11.31 mark, this target implies a massive, double-digit upside from current trading levels. While near-term market volatility is guaranteed, and the stock could certainly test lower ranges or continue to consolidate right here, the long-term, macro horizon for the company looks exceptionally strong. My ultimate takeaway is simple. Tune out the daily market noise. Understand the deeper mechanics behind corporate announcements and avoid emotional trading. The combination of the Taiwan contract and enhanced liquidity structurally solidifies Redwire's fundamentals, making this short report look like a temporary speed bump. What is your strategy for RDW right now? Are you taking advantage of this valuation gap to accumulate more shares, or are you waiting for the upcoming Q2 earnings report to drop? Let me know your thoughts in the comment section below. If you found value in this deep dive and want to hear more analytical market coverage, make sure to drop a like on the video and subscribe to the channel. Take care of yourselves, and I will see you in the next one. Goodbye! This is not financial advice.